Bonds or CDs, which is better for your retirement? One of them offers a little bit more safety, the other one offers a little bit more flexibility. So which one wins overall? For retirees looking for stability and income, bonds and CDs often sit at the center of their portfolio. Both promise predictable returns, lower risk, and reliable cash flow, but they're not identical, especially in today's interest rate environment. After years of near zero yields, rates have surged, and retirees now have choices again. Government bonds are yielding 3.5% to 4.5%, CDs are paying similar rates. And in a world where the safe part of your portfolio can finally pull its weight, that brings us to a dilemma. Which option actually makes sense for your retirement plan? In today's video, I'll break down how bonds and CDs compare in 2025 and moving forward into 2026, the trade-offs between safety and flexibility, and how to build laddering strategies that take advantage of both. Before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. We're in one of the most interesting rate environments in decades. The federal fund rate sits just below 4% range after the Fed has taken its foot off the gas from previous years. The one-year Treasury yield is hovering around 3.6 to 3.7%. The 5-year Treasury is closer to the high end of that range, and the 10-year is somewhere between 4 and 4.1%. CDs, depending on the bank and term, range from 3.75 to 4.25%, and savings accounts are typically falling somewhere within that range as well. For the first time in a long time, cash-like assets compete with bonds. That's great for savers, but creates a strategic question. Should you lock in a CD or build a bond portfolio that can adapt over time? Let's start with understanding the basics. Certificates of deposits or CDs are time deposits offered by banks. You lock in your money for a fixed term, something like 6 months, 1 year, 5 years, 10 years, and in return, the bank is going to pay you a fixed interest rate each year over that time frame. They're FDIC insured up to $250,000 per depositor per bank, which means your principal is effectively guaranteed by the U.S. government. Bonds, on the other hand, are debt securities issued by governments or corporations. When you buy a bond, you're lending money in exchange for interest payments and the return of principal at maturity. Maturity is typically somewhere between 10 and 30 years long. Unlike CDs, bond prices fluctuate as interest rates change. That's called duration risk. If rates rise after you buy a bond, the price of your bond is going to go down in value. Conversely, if rates fall, your bond should go up in value. But if you hold your bond to maturity, you still get your principal payments along the way, all the way up until the maturity date, and then you receive your principal back at the very end, just like a CD. So at first glance, they seem very similar. Both promise fixed income and principal return, but the differences lie in liquidity, risk, and flexibility. Let's start with the safety argument now. For retirees who prioritize safety above all else, CDs are going to be hard to beat. First, there's FDIC insurance, which means you're backed by the government dollar for dollar up to $250,000 per institution. They don't fluctuate in value. You know exactly what you'll earn and when you're going to get your money back. And there's no bond market volatility. No worrying about interest rate swings. For shorter term needs, say money you'll spend within the next 1 to 3 years, CDs can be an excellent cash equivalent. The trade-off here, though, is very limited liquidity. If you need to withdraw before maturity, you'll likely face early withdrawal penalties, typically 3 to 6 months worth of interest. On the other hand, if you want to argue for flexibility, bonds will come with more moving parts, but they do offer more flexibility by virtue of those moving parts. You can buy and sell them on the secondary market at any time. They allow for laddering and duration control, where you can choose the maturities to match your cash flow needs. And you can benefit if rates fall, bond price-wise, which CDs can't offer. Most retirees use Treasury or high-quality corporate bonds rather than riskier junk bonds. Treasuries are backed by the U.S. government just like FDIC insurance, but without the deposit limits. The key difference is that bonds are marketable securities. That means they carry short-term volatility but can also be more liquid in the right circumstances. Something else to be aware of is how each of these instruments is taxed. CDs and corporate bonds are taxed at the federal and state level for those of you with state taxes. Treasuries are taxable only at the federal level. So if you live in a high income tax state like California, where state taxes can be 10% or more, CDs need to earn even more to keep pace with Treasury yields. Conversely, if you live in a state with no income tax, this is a moot point for you, and you're typically better off going with the safer investment, which offers a better rate. Now I want to talk a little bit about duration, and this is something that affects bonds only. Duration is a measure of bond sensitivity to interest rate changes. The longer the duration, the more the price moves when there is a change in interest rates. And here's a general rule of thumb. If interest rates rise by 1%, a bond with a 5-year duration will lose about 5% market value. On the flip side, if rates fall 1%, it gains roughly 5%. In 2022, when rates spiked faster than anyone expected, long-term bond funds dropped 15 to 20%. CDs didn't budge. That's the price of duration risk. But there is a flip side there. If rates decline from here, which they're likely to do based off of what the Fed is saying, bonds could deliver price appreciation on top of interest income. CDs, by contrast, just mature at face value. So for retirees who want growth potential in their fixed income, bonds are the only way to capture that when comparing these two different types of investments. So whether you choose CDs or bonds, laddering is the key to managing reinvestment risk and liquidity. A ladder means buying multiple fixed income investments with staggered maturities. So if you want to stagger it over a 5-year period, you would buy 20% in the 1 year, 20% in the 2 year, so on and so forth, all the way until you get to that 5th year time slot where you're going to allocate the final 20%. And as each matures, you're going to reinvest it into a new 5-year product. The benefits of this are there's consistent cash flow every year. There's reduced rate risk because not all of your money is locked in at one interest rate. There's flexibility to capture higher yields as rates rise, and you can build these ladders with CDs, Treasuries, or corporate bonds. CDs are for the guaranteed principal and no market risk portion of the investment. Treasuries are for the similar safety but better liquidity portion, and you can utilize corporate bonds when you're matching their duration for your liquidity needs and you're looking for some of that longer term appreciation potential. So you want to utilize a mix, using CDs for near-term needs and Treasuries or short-term bonds for flexibility. But always remember to compare interest rates to make sure you're getting the most bang for your buck. Let's go over a real-world example. Suppose you have $250,000 earmarked for low-risk income. So option A, you're going to do an all-CD ladder. You're going to do a 1-year CD at 5.1%, 2-year at 4.8%, 3 years going to be at 4.6%, 4-year at 4.5%, and a 5-year at 4.4%. Your average yield is right around 4.7%, and that's fully insured and predictable. Conversely, if we were to do a Treasury ladder, your 1-year rate would be 5%, your 2-year would be 4.6%, 3-year 4.4%, 4-year 4.3%, and 5-year at 4.2%. The average yield here is roughly 4.5%, and that's state tax free and easier to sell if you need the liquidity. The differences here are very small. It's 0.2% and a little bit of a break in taxes on the Treasury ladder, but the flexibility isn't. Treasuries let you sell at any time, potentially capturing gains if rates fall. CDs lock you in, but they give you a guarantee. So what do you value, safety or flexibility? Let's go over another option now, and this is circling back to those of you in states with income tax. You want to consider another alternative, municipal bonds. Now, municipal bonds are not taxable at the federal, state, or local level if you buy bonds in the area in which you live. For instance, I live in Pittsburgh, specifically within Allegheny County. If I buy Allegheny County bonds, I don't pay federal income tax, state income tax, or local income tax. But let's say I found a bond, a municipal bond that is, in another county inside of my state, specifically Bucks County, which is just outside of Philadelphia. In that instance, I would still be exempt from tax at the state and federal level, but I would have to pay a small local tax rate. For us here in Pittsburgh, that's 1%. In any event, you want to compare the after-tax yields of non-municipal bond investments and CDs to their municipal counterparts. So let's go over a brief example here. Let's say I'm in the 32% tax bracket federally, and we'll use the 3% state of PA tax rate here too. And for simplicity, I'm just going to throw out that local income tax rate because you can bake that into your calculations, but we don't need it for the example here. So let's say I buy a state of PA municipal bond for 4%. A Treasury security in this instance would need to yield more than 5.88% to be a better investment than that municipal bond. A CD would need to earn 6.15% to be a better investment. So just because something has a lower return does not mean it's actually lower after you account for taxes. This is something else you want to consider other than the safety and liquidity features we've been talking about. The smartest approach, though, often isn't choosing one or the other. It's a combination of the two. Here's what you can look at doing. Use CDs for short-term needs, typically 1 to 3 years out. They're safe, predictable, and FDIC insured. Or if they offer a better rate of return compared to their same duration counterpart when it comes to Treasuries or corporate bonds. You want to utilize Treasuries or short duration bond funds for midterm needs. Those are 3 to 7 years away. They're going to add liquidity and potential appreciation if rates do fall. In times when interest rates are high or falling, this should help maximize your return. For longer term stability, hold intermediate bonds. Those are 7 to 10 years out to lock in higher yields today for a longer period of time. And don't forget to sprinkle in municipals if you're in a higher tax bracket and the rate of return is better than what you can receive on the after-tax equivalent yields of CDs and Treasuries or corporate bonds. This tiered approach gives you cash flow, flexibility, and safety, all while reducing the impact of rate changes. So, when should you favor CDs? Well, here's some general rules of thumb. You're a risk adverse investor who values guaranteed rates of return. You also have less than $250,000 per bank, so that way you're fully insured. You don't plan to touch the money you're going to put in the CD until it matures, so you avoid penalties and fees. And you want simplicity and no bond market exposure. CDs are great for sleep at night money, the portion of your portfolio you rely on for near-term spending and can't afford to lose. Here's when you should favor bonds, though, if you want more flexibility or a higher potential total return. You expect interest rates to fall or remain stable, you have large portfolios exceeding FDIC limits, and you're comfortable with small, short-term fluctuations for longer-term gain. Bonds give you control over duration, over liquidity, and over your reinvestment strategy. The bond versus CD dilemma isn't about choosing one winner. It's about matching the tool for the purpose. CDs win on simplicity and insurance. Bonds win on flexibility and growth potential. If you need guaranteed income and peace of mind, CDs are perfect for that slice of your plan. If you want to manage risk dynamically and potentially benefit from falling rates, bonds deserve a place in that plan too. The best portfolios usually include both, a CD ladder for security and a bond ladder for strategy. Together, they can deliver steady income, low risk, and flexibility to adapt to whatever interest rates do next. If you want help building your fixed income plan that fits your retirement goals, that's exactly what we do here at Nav Wealth Partners. We'll help you structure your bond and CD strategy to balance safety, yield, and long-term flexibility. Thank you so much for watching, and as always, make smart money decisions.